Welcome to the Beginner's Guide to Investing in Real Estate. This guide is designed to take you on a simple path to understanding the basics of property investing, generating income, and making your very first smart move in the market. We'll start here with easy to follow steps that are friendly for beginners, helping you build the confidence you need before making your first purchase. Along the way, you'll learn what real estate investing is, how it works, and most importantly, where to begin your journey toward homeownership and financial growth. Let's get started. Let's talk about why real estate is such a powerful investment choice, especially for beginners. First, it's a great way to build wealth over the long term. Property values can increase over time, so your investment grows in value. And at the same time, it can generate income through rent or other means. One key advantage is leverage. With a mortgage, you don't have to pay the full price up front. You can control a much larger asset with a smaller amount of your own cash, which can boost your potential returns. Another important factor is the tax benefits. Real estate offers deductions and depreciation, which can help reduce your taxable income and improve your overall return on investment. So, when you combine appreciation in property value, steady cash flow, and smart tax strategies, real estate becomes a triple threat approach to building wealth. These are the main reasons why many people choose real estate as their starting point in investing. Real estate investments come in several different forms, each offering a unique balance of income, effort, speed, and risk. When deciding which path to take, it's important to start with what fits your goals and lifestyle best. First, there are rental properties. This is a hands-on approach where you buy a home or unit and earn steady monthly income through rent. It requires ongoing management but provides consistent cash flow. Next, we have REITs or real estate investment trusts. These allow you to invest in real estate by buying shares without the need to own or manage property directly. This option involves less maintenance and is more passive. Flipping is a fast-paced strategy where you buy properties, renovate them, and sell quickly for a short-term profit. It demands more effort and carries higher risk, but can deliver faster returns. Finally, commercial real estate involves larger-scale investments like offices, retail spaces, or warehouses. These usually mean bigger deals and longer lease terms, offering stability and potentially higher income over time. Each option has its trade-offs, so think about what aligns best with your resources and goals before diving in. Rental properties represent a slow and steady investment approach. While they might not seem flashy, they offer a reliable way to build wealth through three main avenues. First, there's monthly income. Rent payments can generate consistent cash flow after covering expenses like mortgage, taxes, insurance, and maintenance. Second, properties tend to appreciate in value over time, so your investment grows quietly in the background. And third, leverage plays a key role. You use a relatively small down payment to control a larger asset, allowing borrowed money to boost your returns. Overall, rental income is steady and can be a great starting point for investors because it's predictable, learnable, and scalable. Real estate investment trusts or REITs offer a way to invest in real estate without the hassle of buying physical property. There are companies that either own or finance income producing real estate, which means you get exposure to the real estate market just like owning a building, but in a much easier and more accessible way. One of the biggest reasons beginners like REITs is their liquidity. Many REITs are traded on public stock exchanges, so buying and selling shares is straightforward and fast, unlike traditional real estate transactions. Additionally, the capital requirement is much lower. You can get started with a relatively small investment, nowhere near the down payment needed to buy a property. However, it's important to keep a few things in mind. Since REITs are publicly traded, their prices can fluctuate with the stock market, so market volatility is a factor. On the positive side, many REITs pay regular dividends, providing investors with steady income streams. Lastly, investing in REITs gives you the benefits of property exposure without the responsibilities of being a landlord, such as maintenance and tenant management. This makes them an attractive option for those looking for real estate investment without the usual headaches. Flipping a property involves buying it below market value, making improvements, and then selling it quickly to turn a profit. While this strategy can generate fast gains, it carries higher risks. One challenge is surprise repairs, which can significantly increase your costs and eat into your expected profit. Holding costs, like mortgage payments and utilities, also add up if the property takes longer to sell than anticipated. Additionally, fluctuations in the market can affect the sale price, potentially reducing your margin. So, while flipping is a fast-moving approach focused on renovation and resale, it requires careful management of timelines, expenses, and market conditions to be successful. When it comes to investing, having a clear grasp of the key numbers is essential. These simple metrics help you evaluate cost, income, and risk before you make a commitment. First, the down payment is the cash you put in up front, typically around 20 to 25%. A larger down payment often leads to easier financing and lower monthly debt payments. Next, the cash-on-cash return shows how effectively your invested cash is working for you by comparing your annual profit to the amount you invested. Then there's the cap rate, which gives you a quick snapshot of a property's performance before financing. It's useful when comparing different deals. Finally, cash flow is what's left each month after you've covered rent, loan payments, taxes, insurance, and repairs. Understanding these numbers is crucial. Always know the math before you fall in love with a property. Getting started with investing can feel overwhelming, but it all begins with a few simple steps that help turn your interest into a solid plan. First, assess your finances. Take a close look at your savings, any debts you might have, your credit score, and determine how much cash you can comfortably commit without stretching yourself too thin. Next, get pre-approved by talking to lenders early on. This gives you a clear idea of your budget and positions you to act quickly when a great opportunity comes up. Then, do your homework by researching different markets. Look at rents, prices, vacancy trends, and the overall growth of neighborhoods to make informed decisions before you start shopping. Finally, build a reliable team around you. Find an agent, lender, inspector, and contractor you trust so you have the right support through every step of the process. Taking it one step at a time makes the whole journey more manageable and puts you on a path towards successful investing. When it comes to finding the right property, there are three key factors you want to focus on before moving forward with any deal. First, look beyond the hype and aim for a smart fit, something that truly meets your investment goals rather than just what sounds exciting. Location is crucial. Prioritize areas with strong schools, good transit options, abundant jobs, and neighborhoods that renters or buyers already find desirable. Next, consider market conditions closely. This means checking local prices, rent trends, vacancy rates, and whether demand is growing or slowing down. Finally, pay attention to the property condition. Small cosmetic fixes can often be a great opportunity, but expensive repairs can quickly wipe out your returns. The best property is one that still makes sense after a thorough inspection and careful financial analysis. So, evaluate not just the property itself, but also the surrounding area, the timing of the market, and the scope of any necessary repairs. This careful approach will help you find a promising deal that truly checks all the boxes. When it comes to financing, it's important to understand how it influences your risk, speed, and cash requirements. Different funding options often require balancing affordability against flexibility. For example, a traditional mortgage typically offers lower interest rates and is best suited for long-term investments, but it requires stronger credit. An FHA loan is a good choice for first-time buyers because it has a lower down payment requirement and is designed for owner-occupants, though it does come with some limitations. On the other hand, hard money loans provide fast approval, which is great for quick flips, but they come with higher rates and fees. Finally, cash purchases are the strongest offer you can make since there are no loan payments, but they do tie up a lot of capital. The key takeaway here is that not every deal needs the same type of financing. So it's crucial to compare your options and choose the path that best fits your specific situation and goals. When it comes to real estate investing, there are several common beginner mistakes that can seriously impact your success if you're not careful. First, over-leveraging, taking on too much debt, can quickly turn a single vacancy, a repair expense, or an unexpected rent increase into a major cash flow problem. It's important to keep your debt at a manageable level to avoid these risks. Next, ignoring location is a critical error. Even if the property seems affordable, if it's in a poor area, it might not perform well for years. Location really drives value and tenant demand, so don't overlook that. Poor tenant screening is another trap. Bad tenants can lead to missed rent payments, property damage, and ongoing stress, which all eat into your profits and peace of mind. Taking the time to screen tenants properly is worth the effort. Then there's inadequate reserves. If you commit every dollar without holding back some funds for surprises or emergencies, unexpected costs can hit you much harder than if you had a cushion in place. Lastly, emotional decision making often leads people astray. It's crucial to prioritize numbers and facts over excitement. Let your strategy be driven by careful analysis, not by impulsive feelings. Remember, steady discipline beats chasing quick thrills in this business. Overall, avoiding these common mistakes and maintaining a disciplined approach will help protect your returns and build momentum over time. When it comes to building something meaningful, the key is to keep it simple. Focus on essential takeaways that will guide your journey. Remember, you've got this. Confidence grows when every move you make is clear and well supported. It's important to start small and do your research carefully, ensuring you have a solid foundation. Building a strong team around you can make all the difference. Progress may be steady rather than fast, but steady wins the race. Each smart step you take has the potential to grow into a real, valuable portfolio over time. So, stay focused, be patient, and trust the process.